This is the wife says to the husband, go to the store, lay down the mulch, wash and wax the car, get the kids at school, rent some videos and finish the rest of the dishes. Unfortunately, the husband hears, go lay down and get some rest. Why did this happen? I beg your pardon?
You hear what you want to hear.
You hear you want to hear.
Men speak so fast that men cannot hear.
Okay, it's like they think fast and they think maybe wife speaks so fast. There are 3 birds on a tree. 2 decide to fly away. How many birds on the tree? 2. 1. Who said 1? Who said 3? How many? 3, 4. Who said 2? 2. 1. This is something like the same thing. I was not very fast in talking, but still it's the same problem. This is mental shortcuts. This is heuristics in the real sense. 3 birds on a tree, 2 decide to run away. They have decided to run away, they have not run away. So there are 3 on the tree. But when I loudly answered how many 3, there were more noises about 3. But when I how many 3, all those people went up. Why? Lack of self-confidence. Lack of self. Just 3 was the right answer, but you should be knowing why the 3 is the right answer. Why should there be a self-doubt? Now, in that incident or in this husband's incidents, what happens is the brain always takes shortcuts in making decisions. It does not process all the information, and because you don't process all the information, we tend to get biases. Now this is the most important thing. This is a part of the reflexive thinking, but we have to be very good listeners. Problem happens that we are always good talkers. When you listen properly, this husband, he may not be listening properly, so he listened exactly what he wanted to hear. The birds flying was what? It was very clear. But the problem was not listening properly and not analyzing the information which is coming. And there are so many incidences in our life that the brain goes on taking shortcuts. And when your brain takes a shortcut, what it does? It goes in the comfort zone of following a rule of a thumb. There are so many rules of thumb which we go on following blindly. Anybody can tell me which rules of thumb which we normally follow? Any rules of thumb? Can you guess? I'm talking to you only. Prompt him, then also he'll talk now. Yeah, him only. Sunday is a holiday in school, colleges, still we are over here today. It's a rule of a thumb actually. Sunday is holidays and we do that. So there are tips is also a rule of a thumb. Give it at the end of the. So in our life there are so many rules of the thumb which we go on following blindly without even understanding the relevance. Since we are going to deal with these behavioral biases, one is cognitive and emotions. Emotional we have already done with, which I just explained. Since cognitive biases stem from faulty reasoning, Better information and advice can definitely correct them. However, emotional biases, they actually originate from impulse and intuitions rather than conscious calculations, and thus they are very difficult to correct. So something like a loss aversion, sunk cost fallacy, endowment effect, they are really difficult to correct. But what we will learn during this next session, I want you to really participate, because the more you understand about them, the more you will be confident of getting rid of them. Emotional biases are something like loss aversion and all, which I talked to you, while cognitive biases are something like availability, representativeness, anchoring, herd mentality, a lot of things which we'll start taking in due course. Okay, we'll start with the overconfidence bias. That is when we think that we are smarter than what we really are. It's like I've got an attendance sheet. People were supposed to mark the 7th. They both have marked 8th. And now they are not over here. Now, this is a sort of an overconfidence bias. What a stupid overconfidence bias, that if I check just now the same goal, I will know exactly what those people are. But this is what happens is that people normally always believe more in their own abilities or in their knowledge, which actually is really not the right thing. Another thing on this is, when you are overconfident, you tend to underreact to any new information that comes to you. You have two types of overconfidence biases. One is prediction overconfidence, that is about your knowledge. Another is certainty, that how certainly you will know, it's about your ability. Classic example of prediction overconfidence is the case of former executives of family legacy businesses, like the Reliance, the Tata Group, the Birla Group. Their investors, that means the family investors, often refuse to diversify their portfolios because they claim insider knowledge and have an emotional attachment to the company. That's why they cannot conceptualize these stocks as risky. Like if you own some of your family shares, you always believe that it is the best thing you have, because you believe that you are in control of it. It's an illusion of control also. However, if you see scores of such companies like the Mafatlals, the Orkes, Scindias, they all have beaten the dust. Now this is a classic case of prediction overconfidence. Now certainty overconfidence, people display in everyday life situations. People tend to have too much confidence in the accuracy of their judgments. They fallaciously equate the quantity of information with its quality. This was evident in the technology sector boom, where people piled up technology stocks on the overconfidence of the emergence of the new economy. They all believed this thing, that the emergence of the new economy will always give way for and destroy the bricks and mortars. Now, how would a behavior result from overconfidence? Investors become blind to any negative information which comes to them when you are overconfident. Overconfident investors believe in their knowledge and ability to get in and out of a stock. That's why they go on trading excessively. They blindly believe in the knowledge and ability to bet on concentrated stocks. That is the reason they underestimate the downside risk and hold on to undiversified portfolios. Let's go to the overconfidence quiz which he had given you. Give high and low estimates in kilograms for the average weight of an African elephant. It's the heaviest elephant in the world. Choose numbers far enough apart to be 90% certain that the answer lies somewhere in between. Second was, give high and low estimates for the depth of the Indian Ocean in meters. choose number enough apart to be 90% certain that the answer lies somewhere in between. And third one was, how easy do you think it was to predict the crash of 2008? I don't know if you guys remember the quizzes. You remember your answers? Because I thought you would be having them, you know. Now, suppose in the first instance, if you had given a weight interval of 1000 to 2000 kgs, the average weight is 8500. Now here it's not right or wrong. See, don't get it. But when you give too restrictive 1000 to 2000, what did you show? You show your predictive overconfidence. And those of you who told between 1000 and 10,000, you are not suffering from, because you don't know the answer exactly. So you want to leave a big leverage to see that you go right. So here the question was not that what is the weight of the elephant. Here the question is how you look at that. When you are told to estimate, when you have too much of overconfidence, you will try to put a too narrow range. Like 1000 to 500 to 1000, someone would say that also. When you keep a higher range, that means you are showing that, well, I am not very overconfident, I really don't know about this, so I'll keep a higher range. Because here you are supposed to keep a range to be 90% right. So it was so simple to even keep a range, this thing, of 1000 to 10,000. You would have kept that. And you would have been 90% correct because you would have been in that range. Then high and low estimates for the depth of the Indian Ocean. Again, depth. What is the average, the depth of the Indian Ocean is 890 meters. How many of you went to the net to check all these things? That is one thing you shouldn't have done. Because the answer was not this, because you are told, give high and low estimates. It's your, so those who told 500 to 700 were again, this thing, too cramped in their thing. That showed their overconfidence level. Well, anyway, when I did this about 10 years back, I had done the same thing, you know. Went on the internet and checked, you know, but then Harsh Shefrin told us, well, you are not supposed to do that. You are supposed to answer this question. Going on the net and checking was also a step of showing that we are very confident, because even Harsh Shefrin, that time he knew that you could all go and check. So, but I was never asking for this, you know, because now with the internet you can get answers for anything. Now, how easy do you think it was to predict the crash of 2008? How many of you have told that it was easy? You want somewhat easy. That was also very overconfident, because it was not possible for anybody to know. I have been in the market for so many years. Even I know this thing, it never became possible for me to know whether the market will go down or not. Yes, if you have enough experience in the market, you know something is going wrong. But I'll tell you, after doing this course on behavioral finance, I can assure you, you'll be at least 50% much better off to understand something which is wrongdoing. 2008, we were the only brokers in the market holding seminars for our people, asking them to invest into stocks. 2007, we got all abuses from our clients because we were managing the money and we were about 30% into cash. Some of our clients took the money back also. Oh, what is this? We have given you to manage, you are not doing anything. We explained to them, this is an opportunity money at 21,000 index. You cannot buy stocks. It is, we knew that something was wrong somewhere. But we could never predict that 2008 will happen in October. But knowing the greed which was happening, knowing the way the IPOs were being oversubscribed, like when Reliance Power IPO got oversubscribed, we were sure that bad times are going to come. And bad times came after about 6 to 8 months. But you have a little inkling that something, like in 2008, when the markets were down and out, we knew one thing, that the values are available at the right price, and if you have the money, you can buy stocks. The problem at that time was that stocks which represented only profits at that point of time they were only representing losses. Everyone wanted to get out of stocks. And that was the time where you are confident that if you buy stocks at such great valuations, you know, like there were stocks like Memphis, which is owned by HP. They were available at about 5 to 6 times earnings. Nothing wrong had happened to those companies. But we knew that there was excessive fear in the markets. And when there is excessive fear, you are definitely able to find values in the market. And you would also, over a period of time, start to at least recognize that all is not well, all is not good, and times are changing. Now I don't know whether you remember the certainty index. How confident are you getting regarding your ability to choose stocks that outperform Nifty 50? If you have greater confidence, that means you are again suffering from certainty over confidence. Now, relative to other classmates, how good a stock market predictor are you? How many? What were your answers? Average, good honesty. The best in class, nobody was the best in class. Now nobody is going to say. Okay. Toronto is the capital of Canada. Do you agree or disagree? How confident are you that you are correct? Disagree. Options were 20%, 40, 80, 100. 100% disagree. Okay. So you got the idea what I'm trying to tell you. Okay, the second bias is the representativeness. Fit no stereotypes. Don't chase the latest management fads. The situation dictates which approach best accomplishes the team's mission. That has to be the basic idea. This is by Colin Powell. What is representativeness? Processing new information by simultaneously incorporating insights gained from visually relevant analogs and past experiences. Here we confuse random fluctuations with casual patterns. Think of this as something like a similarity heuristic. We think that a 6 feet 8 inch African American is more likely to be a basketball player than a 5 feet 6 inch Indian, because there are more tall black basketball players and not too many short basketball players who are Indians. Now, so when you see that, you see an Indian, if he is short, you will not put him in the league of basket. That is representativeness. It's Tata Steel comes out with excellent results. Jindal Vijayanagar Steel would also start going up. Why would it going up? Because Jindal Vijayanagar Steel is representative of Tata Steel. And because Tata Steel is going up, people believe that this will also go up. So they start accumulating that stock. This happens a lot in the stock markets. Any sector doing well, all the laggards in the sector starts going up. In a representative bias, what happens is you always overreact to any information that comes to you. I don't know whether you remember the dot-com bubble. There were companies which came out with IPOs just adding the word .com, and they would command a fantastic premium. Same thing has happened in last 2-3 years with the real estate stocks going up. You had so many real estate companies which hit the market, so many infrastructure companies which hit the markets. Reliance Power was about advertising only powering India. What it wanted to be representative of providing power to India. It wanted to use the representative heuristics in the minds of the people who would blindly power deficit India, and Reliance is going to power India. Now understand this, how representative heuristic worked with people that it became the mother of all issues. GDP growth and stock prices. GDP is growing, so stock prices are going. GDP growth has no relevance with stock prices. As I told you last time, if Jet Airways, Kingfisher buy 10 new aircrafts each and people start flying, all this will be added to the GDP growth. But that doesn't mean that both these companies will start making profits, because there would be competition, they would bring down their prices, so they may or may not make profits. But here, when a GDP growth comes, the stock market as a whole starts going up. Second-rate stocks in India start rising because the leaders are doing well. Base rate neglect. If Tata Steel comes out with excellent performance, all the laggards in the steel industry starts going up. They become representative of Tata Steel and benefit from the classification, the steel sector. This reasoning ignores certain variables like finances of the company of a laggard which goes up, the management, the productivity, labor trouble, etc., which could hamper the progress of such laggards. But without thinking, people will just go on buying the laggards and will go up. That is this is the base rate neglect. We did one case study on that. We'll come to that case study again over here. Then the sample size neglect is people fail to accurately consider the sample size of the data on which they base their judgments. Examples of BSE, Sensex 30 and Nifty. Now, I told you last time also, BSE, Sensex is 30 stocks, Nifty is 50 stocks. But we still ask, what is the market? And we only talk about BSE or Nifty. So it is basically a very big sample size neglect. Now you will tell me you are teaching all these things, but why they don't change it? Because when a wrong which is done by a majority of people, it ultimately becomes the right. Always remember that, That's why you hear too many lies of India shining, it ultimately became the truth till the BJP lost the government, lost the elections. So there are things in life, because of such heuristics, for a certain period of time, they think they are able to really dominate the decision making of a lot of people. We did those case studies 2 and 3, which we just discussed. The hot IPO is representative of a good long-term investment, was one part of it. Now from the case study point of view, it was there. But why did we discuss that thing in future? Because this thing in detail is because there were a lot of other heuristics which were overlapped on that. And what I really wanted to show you is the mental heuristic, that some people picked up on certain information, some people picked up on certain information. So everyone is thinking differently and they pick up on different types of information at different, depending upon what their thought process at that point of time is. Sample size neglect was Ravi's reasoning demonstrated the pitfalls of sample size neglect. Like we already discussed that 3 sample size in last 1 month was not the right sample size to really make a decision. Now, what are the cautions you should take when you are dealing with representative bias? One is, normally you always go by money manager's track record. Now, track record has to be for a longer period of time rather than a very short period. And today the advertisements which you see, an X fund, we have returned so much, 43%, 33%. Now all those figures are taken from the same data, but for what period of data they give you is not mentioned. If you get into the details, we find that the period is much more shorter. There was one fund which was advertising. It was in last 6 months they had performed. But if you put all that performance for the last 5 years, it was still down. But this is a way they start projecting their performance. A good company and a good stock. This is another mistake people make. What is a good company and what is a good stock? Like Infosys. Everyone would agree that it is a great company. Can it be a bad stock? It cannot be a bad stock. If it's a great company, how can it be a bad stock? But it depends on when you bought it. In 2000, Infosys was as great as a company it is today. But Infosys stock was a very bad stock. Most of the people base their decisions on it's a good company, so it's a good stock, so you buy it at any price. That's a wrong representative bias to use. Because ultimately, when you buy a stock, you have to understand that what is your margin of safety and what price you are paying for it. You are not buying the company, you are buying a stock of a company. So it has to be available. That business has to be available at a good price so that you make money in the future. It has to be available to you at a discount to the intrinsic value. Salesman and an investment advisor. So many of you have got into the financial services sector. Under the guise of investment advisors, most of you would be only salesmen or saleswomen trying to sell certain things. Believe me. Because an investment advisor is very different from a person who is trying to sell. But today what has happened is, because I'm in the markets, I know that all these big companies and big banks and all, they just get good, smart people, ask them to sell. Most of you, in your initial first 2-3 years, you'll only end up selling mutual funds or financial products to the clients. Believe me. And you can always, once you have realized, you can drop me an email that, well, you are right. Because I will be right, I know that. IPOs represent profit on listing. That's also another representative. IPO lega because it's them cheap. IPO means initial public offering. But today IPOs are priced at market. So if the market has 7,000 stocks, you have an opportunity to buy anything. Why an IPO only? We have got a full full session devoted to IPO pricing. I will deal with that during the course of this. So I will not go details into that. But the case study was there for you to understand that it was an IPO. That's why that person ran into investing into that IPO. Secondly, we go by house names. House of Tatas, House of Birlas. That means it has to be good. It is coming from this. No doubt. Some of these houses are really credible houses. But that doesn't mean that any company which they come out with is always a good company. You got to be discreet in your, you got to analyze that information and not be swayed away by a representative heuristic. Secondly, always when markets are up, people are always thinking the stocks are the best thing to do because they are representing profits only. When you buy, everyone around you is talking about profits, profits, profits. So you also start believing that, well, stocks represent profits. When the markets go down, as it happened in the the bear markets in 2008 with the world, stocks, nobody wanted to go because they were only representing losses. We saw this base rate, those who chose option 2 are likely to suffer from base rate neglect representative. While it is possible that he may do both, it is more likely that he only coaches the students. You got that quiz? Praveen is an ex-college level year. Do you remember that quiz, no? So suppose if you chose 2, likely to suffer from base rate neglect. It is possible that he may go, but it is more likely that he only coaches the students. See, these quizzes and these case studies, they may sound a bit odd to your logic, but your logic has not to be applied here. The idea of giving these quizzes and this is so that you understand what, because nothing in life is going to be totally perfect. Even I don't have the answers that this is there. I'm just giving you an idea that to this level you can always consider that this could happen or this could not happen. This was the sample size. The BSE Sensex has risen by an average 3.44% per annum for the 3 years. November 9, 2010. During the same period, the top 10 income-oriented debt mutual funds have given a return of 8 to 10%. Which of the following is more likely? Income funds will beat the Sensex over the next 1 year. The Sensex will beat the income funds over the next 1 year. I don't know how many. What were the answers? Any of you? Sensex will beat Sensex. both the outcomes are equally actually likely. However, as we increase the number of years or the sample size, it will be evident that the Sensex has performed much better than the income funds. Sensex since last 20 years, if you see, it has performed on an average about 18% per annum. Smaller the sample size, less accurate the conclusions can be made. For instance, if we extend to the study to 5 years, the Sensex returns jump to around 20% per annum, while the top 10 debt funds returns just remain merely 10%. So the longer sample size you take, it is better. Here it is strictly not comparable because income funds are very different from equity funds. To reach a port, we must sail. Sometimes with the wind, sometimes against it, but we must not drift or lie at anchor. Now we did that case study on the anchoring subject. Sapna was so anchored to that price of 20 that it was not allowing her to adjust accordingly to any new information which was coming to her. The new information came in the form of there is some problem with the accounting, so many other factors which came in, but her anchoring was not allowing her to take a decision. Numerous studies have demonstrated that regardless of how initial anchors were chosen, people tend to adjust the anchors insufficiently and produce end approximations that are consequently biased. Suppose you are asked whether the population of Mumbai is greater or less than 20 million. Obviously, you will answer below or about 20 million. You will always, it is obvious if I tell you it's up or down. If you are then asked to guess an absolute population value, your answer will fall somewhere between 20 million. Because what I did is, I have given you an anchor of 20 million and then I am asking you all these questions. So in real life also, when you get something with a figure, you will tend to deviate between this. You will never go over and above that. So when required to estimate a value with unknown magnitude, people generally begin by envisioning some initial default number, an anchor, which they then adjust up or down to reflect subsequent information analysis. You know, they had done Harsh, a friend in our class at Amsterdam, he had done a quiz with us. Take the last 4 digits of your phone number, add an X amount to it, you see, and what was the date when Attila the Hun was born. Now, it had no relevance to that. But most of the people, they think with that, because what does your 4-digit last numbers have any relevance to that? But in spite of that, they think the anchoring was so strong that people try to put between that, thinking that there must be something between that. But there was nothing over there. It was just to show how an anchoring effect works. In simple terms, being unjustifiably influenced by the past, causing people to underreact to any information which comes to you. Sapna anchored to price of 20, a decision should be based on severity of the accounting problem. Okay, now what would be the investor behavior in anchoring processes? Purchase and sell decisions, you got to be very careful. Because if you have seen a high market and if you want to purchase, there's no problem. But when you want to sell, then it becomes very difficult because you are anchored to those prices. Similar is the case opposite. Secondly, we get anchored to brand names. If a strong brand name is there, or a strong house name is there, then you are anchored to that and you believe that anything which comes from that, it has to be good. Secondly, as I told you, index is a very wrong representative, but still, in spite of that, it serves as a very strong anchor. How much has the market gone down? Oh, it's gone down. So there must be something bad. But maybe if your stock portfolio vis-a-vis the Sensex, then it could not have gone down at all. Which we have really realized because only 30 stocks move up and down. It really does not affect a lot of your even individual portfolios. It will not affect. Why cannot people exit junk stocks? I had a client of mine, he would only buy junk stocks. He would always be trapped into the junk stocks. When the junk stocks are down and out, he would be always swearing that no, next time the market comes up, I'm just going to get rid of that. Because in bad time, junk stocks are not even sellable. So when the market comes up, I'm going to sell this up. When the market comes up, my people would tell him, now you sell off, no? No, abhi iska to kitna, pahla 200 ka bhav dekha hai, and you are telling me to sell at 15 rupees, how will it sell? It will go to 15, 20, 25, 30, it will go again come back. And he is still holding junk stocks in the last 15, 20 years, and he has been holding on till they are delisted. But it becomes very difficult because every time he is anchored to those high prices. Then in the tech boom, there have been so many high prices, or in every market, every sort of a big boom, you will have a lot of anchoring effect taking place. And when the new trend starts, when the old trend is out, all those stocks just go down and people are always waiting that those stocks again will come up. No, it never happens. Because in the market, stock prices are fluctuating because of different types of emotions and sentiments of people. And it is not possible that the same sentiments and same emotions can come back again. It doesn't happen in 95 to 99% of the cases. Once in a way it can happen if something different happens. Again, state of the economy, GDP growth, I have already talked to you. It has no reference. Anchoring also. Apna GDP is going at 8%. That's why people are not selling stocks. In fact, if you really analyze, your GDP is good. How many scams and all we are hearing and reading about in our country? It's not only a question of corporate governance, but it's also a question of whether contracts are being honored or dishonored. Now, if the markets are going down, the GDP is going, GDP good figure comes, next day the market goes up. Now, that is automatic thinking. GDP upar hai to market hai. But if with a reflexive thinking, if you see, first is the Devas deal, the government just scrapped it. How can you scrap a contract which has been made? You cannot scrap it. Give you another incident. Like last time I talked to you about Noida toll bridge. I was discussing with you. Noida toll bridge, when it's run by excellent management, came out with a public issue. It's doing well. It's running at 50% capacity utilization. Just last week, they increased the toll prices because it was in the contract that they can increase their toll prices. The government contract was there, yeah. The Noida government, that is the UP government, they say, no, sorry, you are not allowed to increase the contract. Increase the rates. And a political party, they didn't allow the roads to go on Noida because they had increased the rates. Now, if we are really looking and analyzing this sort of information, well, I would say that the FIs are running away, not because they are scared of the markets, because they are not sure whether the contracts will be honored. This is how I would really look at it. Advantage of anchoring are also very important. When you are negotiating, you can always put a person to a high anchor and start negotiating with him. Being aware that you can be anchored to a price, is also a very good tool for you, in your negotiating habits. When advising clients on a sale of security, encourage the clients to ask themselves, am I analyzing the situation rationally, or am I holding on to attain an anchored price? If you talk to your clients in that language, you think they will understand better rather than telling them you buy this or this. Help them to do this. Give them a nudge to make a decision. When making forecasts about the direction or the magnitude of the markets or individual stocks, ask yourself if your estimate is rational or subject to anchoring. Because if some of you would get into analyzing also, the normal mistake what you will do is, which 99% of the analysts make, is you are anchored to what the others are doing. Because it becomes very difficult to be a contrarian and then go wrong. So what you try to do is, what are the others forecasting? If everyone is forecasting 4%, you will try to put it at 4.1 or for the 3.9. And this is how the business of analysts work. There are only a few analysts which really shine, because most of the other are anchored or don't want to take the risk to really take that extra challenge or take a contrarian point of view. So you also got to be aware that in a competitive bidding, you have to be very, suppose if you are going into an art auction, or if you are going into a job opportunity, which also today has become as a competitive bidding. Are you going to be anchored to what? What are your priorities? Because sometimes the job may offer you a whole lot of things where you can learn very good, but the salary may not be there. But if your anchor is only going to be salary and not learning, you are tend to lose out on the future career prospects in your life. And this happens in the job circle in a big way, because giving you blackberries is one anchoring effect. Then trying to tell you this thing, you'll get 2 credit cards, you'll get this. The credit cards you'll get, but the credit has to be yours only. You're not going to get anything. So most of the way the job opportunities or your pay packets are all structured. If you know about these anchoring effects and all, you will be able to really decipher the same things and come to the right conclusion. Anchoring, this is the quiz. You own 4% of the equity capital of Consumer Med, a pharmaceutical company which currently trades at 100. You are keen to sell the stake in order to fund another venture. An investment banker calls on you, stating that a client of his is interested in purchasing the same at rupees 120 per share. While you are considering the same, the key stock market index plunges 20% within a matter of a few days, owing to bad economic news emanating out of the US. Consumer Med falls 25% and is now quoted at rupees 75. The prospective buyer is now considering an offer of rupees 90. In other words, it is likely that he will pay the same premium, 20%, to the prevailing market price. What will you do? A, you decide to hold on to the price of 120. B, you decide to reduce the price to rupees 100. C, you decide to accept his offer. D, you indicate to the banker that you are even willing to accept rupees 85. C. So well, in case if you have chosen A or B, you are susceptible to anchoring bias. By anchored to the prices prior to the fall in the markets, we are ignoring the changed realities. It is ironic that the greatest stock bubble coincided with the greatest amount of information available. Always said that this would be a good thing, but maybe it was not so good. This is James Cramer, CNBC. This is availability bias. You make decision based on the all readily information which is bombarded on you in recent times. So it's known as also a recent effect, the recency bias or the availability bias. It is the rule of the thumb or a mental shortcut that allows people to estimate the probability of an outcome based on how prevalent or familiar that outcome appear in their lives. If you are susceptible to having a cold every 15 days or 1 month, then that availability heuristic of you being very careful about catching a cold will play very heavily in your mind. Or, just now, the World Cup fever is there. So you will have a lot of information coming to you. Your mind is definitely going to be pulled away by cricket, whether you like it or not, but you will start following certain cricketers. Because all your advertising media and all, they will only talk about all these things. Simple terms, people are more influenced by recent events vividly and colorfully displayed. Decisions are based on the fastest recall value. What you will recall in this next 10 days, one would be the World Cup, secondly would be the budget. Then what is your today's best recall value? That the government has agreed this thing to free some Naxalites in lieu of that district collector which was, because that is today is the headlines. What is the next headlines? Virendra Sehwag is the headlines. So all your decisions would be based on what has been fed to you today. India shining, I've already discussed with you so many times. FI buying. Well, if FI is buying and the markets are going up, why are the FIs buying stocks? Can anybody tell me why are the FIs buying stocks? No, why are they buying stocks? To make money, correct? Now how will they make money? If they sell stocks. So today any buyer of a stock will ultimately sell stocks. But when FI is buying, people believe, okay, let us also buy stocks. When FIs sell, when the markets go down, oh, FIs are selling. But well, there is nothing new which they have done. A person who had bought stocks will one day sell stocks. So what great thing are we talking about? But the markets fluctuate on all such information. Current fancies of the market. Real estate was a fancy. Slowly it is dying down because a lot of inquiries is coming on real estate companies. Telecom stocks, scams, they are affecting all the prices of all the telecom stocks. Go for yourself and check. You'll find that all of those stocks are going down because the availability bias regarding 2G is so strong that nobody wants to touch telecom stocks. Budget blues. You're going to see a lot of ups and downs in different stocks because of the budget. One day you'll have an information that the FM is going to give subs for this, that sector will go up, those stocks will go up. Next day some information will come. So in next 10 days you're going to see a lot of fluctuations in the stock markets based on the available information which will be spread to all of us. Visual and print media play a very important role. They can actually make or break a person. The same people, one day they were showing Raja, this thing waving when he got down from Tamil Nadu. Now they show Raja, this thing subdued and all. So you also start believing that there's something terribly wrong over there. Then, another is, how many of you just invest into blue chip stocks? Nobody thinks highly of blue chip, only you? Blue. Now, even what is a blue chip? It's an availability bias. Once upon a time, all these were blue chips. All these were 12. So never have any idea that, well, it's a blue chip stock, that's why I want to get into a blue chip stock. There's nothing like a blue chip stock. These were just blue chips of the yesteryears. I don't know, you guys got the same quiz? Maybe. As per WHO report, in 2006, approximately 7% of deaths worldwide occurred due to respiratory functions, as against 5% due to AIDS. However, you may have chosen AIDS merely because news of AIDS is so bloated, this thing for all of us, and it's so scary that we have all the information about that, and that's why we start, you would have chose A, or if you would have chose C, or you could have chosen A. In the second one, if you chose C, that was, you plan to purchase shares in a software company, Infobyte, after undertaking the requisite research. However, as you are about to place the order, you hear that its peer Technomics has announced bumper results. Do you use Technomics results as confirmation that your research on the sector is accurate and proceed to purchase Infobyte, or put your purchase decision on hold pending your research on Technomics in order to determine whether it is a superior investment? Or C, you buy Technomics instantly believing it to be the flavor of the season. If you buy and if you choose C, then you are definitely, because of the available information, you are making that decision. And as I told you about They're saying AIDS and respiratory functions.